Credit spreads are very well-known strategies, and you can really use them so as to be bullish, bearish, or even neutral when you're trying to place a trade. That's why in this video I wanted to show you what are credit spreads, how you can use them to your advantage, what are the risks also of credit spreads, and how you can use them in smaller accounts. And if at any point you find this video interesting and you actually learn something, please consider subscribing to my channel and liking this video. That's really the best support you can give me, and I'd really appreciate it. And when we talk about credit spreads, you could be bullish, for example, using a put credit spreads. You could also be bearish using a call credit spreads, or you could also be neutral using a short iron condor, which is the combination of a call credit spread and a put credit spread put together that gives you a short iron condor. And I guess the first question to answer is, why in the first place would you want to use credit spreads? Because if it was only about direction, you could just buy a call or a put so as to say if you want to be bullish or bearish, and that's it. And I guess the most important thing to understand about credit spread is their implications in terms of time decay and volatility. I'm sure that you already heard about the time decay, meaning that every day that passes, options lose a tiny bit of value, and that's called the time decay. And the closer we get to expiration, the bigger that amount. And the volatility that I was just talking about before refers to the implied volatility, meaning the demand for options. And depending on the strategies that you're using, you're going to have different implications in terms of time decay and implied volatility, meaning that you're whether going to benefit from the time decay and a reduction in the implied volatility, or you're going to suffer from them. And credit spreads are what we call net selling strategies. Why do we call that net selling strategies? Well, to understand why we call them net selling strategies, we need to understand how we can build a credit spread in the first place. Let's say that you were looking at a stock like Zoom, for example. Zoom has been increasing since the start of the pandemic because everyone uses it, and let's say that you are bullish on Zoom. To express your bullish view using a credit spread, you need to use a put credit spread. You need to sell a put and buy a put at a lower strike. And when you sell a put and buy a put at a lower strike, you see that the put that you're buying at the lower strike has a smaller value than the one that you're shorting at the higher strike. Let's say that you're shorting a put that is worth $3 and you're buying a put at a lower strike that is worth $2. As you're shorting the put that is worth $3, you receive $3 of credit. And as you're buying the put at the lower strike, you're paying $2 of debit so as to buy this put. And in the end, when you sum up the two, the fact that you collected $3 of credit and that you paid $2 of debit, what you have in the end is $1 of credit, because the negative is bigger than the positive. And that's why we call credit spreads net selling strategies. And when you short options compared to buying options, the time decay and the implied volatility are going to play differently on your P&L. And remember what I said about the time decay. Every day that passes, options lose a tiny bit of value, and the closer we get to expiration, the bigger that amount. And as we're shorting options here when doing credit spreads, and that's why we're calling net selling strategies, well, every day that passes is going to benefit us, because as the time decay is happening and we are shorting the option, we essentially want the options to lose value so as to buy them back at a lower price. And the time decay is exactly doing this for us. The time decay is taking a bit of value every day out of the options, and as we're shorting them, we're making a tiny bit of profit every single day. Compared to if you were buying an option, the time decay would make you lose money, because when you buy an option, you want to buy it at a lower price and sell it at a higher price. And so as the time decay is actually taking money out of the option, while you're losing money when you're buying an option. And that's why when using credit spreads, the time decay become your ally, because now the time decay is benefiting your P&L as it's taking a bit of value every day, which is exactly what you want as a short seller. So now that we talked about the implication of the time decay on credit spreads, let's talk about the second implication that I just talked about before, which is the implied volatility. And to make it very simple, if the option prices are increasing, so does the implied volatility, and if option prices are decreasing, so does the implied volatility. And as we're shorting options, we want the option prices to decrease so as to buy back our options at lower prices and make the differences in profit. So ideally, when you're using credit spreads, you want to use them on stocks that have very high implied volatility relative to what they had during the past, so you have some confidence in the fact that option prices for that particular stock are actually expensive, so they have room to decrease, so you can buy your options at lower prices and make a profit as the difference. Compared to if you were buying options, you would want to buy options when the implied volatility for the stock is very low, so it has a lot of potential for the option prices to go up. And that's why I said that they there were some implications when talking about credit spreads is because as we're shorting options, the time decay is actually benefiting us and the implied volatility decreasing is also benefiting us. So let's take some examples now so you can understand how to build some credit spreads. Let's look at British Airways for example, and let's look at the December expiration. If you were bullish on British Airways, you would have to sell a put credit spread so as to express your bullish view. And to be able to sell a put credit spread, you need to sell a put and buy a put at a lower strike. And you can see here that the two strikes that I've chosen have a width of $5, meaning the difference between the two is $5. And to give you a quick tip so as to be able to calculate quickly what is going to be your max loss, other than the fact that your broker is probably going to show your max loss, you have to take the width of the strike times 100 minus the credit received, because the credit received is going to be your max profit. So your max loss is going to be the width of the strike minus the credit received. It's a small tip and it's quite funny to know if you can say it maybe at the next party or not, because we're in coronavirus times. But if you're changing the width of the strike, let's say that you go from $5 width to $10 width, now your max loss is $1,000 minus the credit received. And you can see that when I go into the analysis tab of Tastyworks and I start moving the spread whether further out of the money or closer out of the money, you can see that when I move the credit spread further out of the money, the probabilities of profit are increasing, but my max profit is decreasing. And when I move closer my spread to the at the money strikes, you can see that my probability of profit is decreasing, but my max profit is increasing. And that's completely normal that this happens. And if you were absolutely sure that your spread was going to expire out of the money, meaning that you were going to make a profit, no one would be ready to pay you this because it's almost sure that your spread is going to expire out of the money. So with credit spreads, it's really a matter of balance. You need to have enough probabilities of profit and still be able to collect a big enough credit. And to understand what type of credit you should receive, I really suggest you to watch my video on credit spreads that I've already made before. It tells you how to know which credit you should aim to receive. But if I was now changing my mind and I was now bearish on British Airways, instead of doing a put credit spread, I would just have to do a call credit spread. And to be able to do a call credit spread, you just have to sell a call and buy a call at a higher strike. And you can see now when looking at the profit and loss graph that I'm now bearish on British Airways. And now the last type of trades, short iron condors. And as I said, short iron condors are neutral strategies, and so as to be able to build a short iron condor, you need to combine a put credit spread and a call credit spread. And when combining the two, you're going to see that it's going to create a profit and loss zone where if the stock stays within that zone, you're going to make a profit at expiration. But how can you sell credit spreads in smaller accounts? Because that's the title of this video. And how can you do when you have a small account and you can't afford, for example, to have a 400 loss on a trade? Well, to be able to only have, for example, losses of maximum $100, you need to go for cheaper stocks. You need to find stocks with $1 increments between each and every single strike, so you can have the choice of just having $100 loss maximum when building a credit spread. And I've already built a watch list with plenty of cheap stocks where you can make credit spread with $1 increments on each and every single strike, so you can have really minimal losses. The link will be in the description of the video, so if you have a small account and you want to start trying credit spreads, don't hesitate to download this watchlist and start selling credit spreads on those stocks as they are quite cheap. And I really recommend you to go for ETFs also if you have a small account and you want to use credit spreads, because ETFs like for example XLF, XLE, XLV, XLK, and all of those ETFs are in general quite cheap, and you can manage to sell credit spreads with very small capital requirements and so very minimal losses. And I think it's a very good thing to trade ETFs because as they are composed of different stocks themselves, you're not going to have a huge volatility when trading ETFs, which can be a good thing, especially if you're just starting out and you want to try credit spreads. And all of the ETFs that I just talked about, for example XLF, XLE, and all of those will be available in the watchlist that is in the description of the video. I hope you enjoyed this video and credit spreads are now making a bit more sense to you and you actually learned something. If you've been watching until the end, thank you so much for having watched until the end. I really hope you enjoyed the video, and if you've been enjoying it, please consider subscribing to my channel and liking this video. I'd really appreciate it. I wish you all the best, please trade safe, and I'll see you in the next video.